Hey everyone, we're looking at a company today called Schwazze in the cannabis space. That's how I'm pronouncing it anyway. Schwazze optically is actually really cheap, and I need to go see if it's actually a good business or not. I'm going to compare it to the other MSOs, and we'll put it on my tier list at the end of this episode too. So they're a little bit different to the other MSOs, I guess, because they've got this sole focus on Colorado and New Mexico, just those two states, and most of the other players aren't in those states. The plan for them is to really understand and dominate those two areas first before getting into the too land grabby in other states. And I think this dial-in focus is actually really important and something I like to see. Now, Schwazze aren't that small. They've got 60 locations split between Colorado and New Mexico. And on the size scale here, they're they're not in the pushing 200 like Trulieve and Curaleaf, but they're not that small either. 60 is quite a lot. So if you've been following along with my cannabis videos that I've been putting out, you'll notice that most of them are over-the-counter stocks, so you're going to need access through Interactive Brokers. There's a link in the description for that. That's the broker that I use for all my investments, not just cannabis-related stocks, but it's good that I can access the cannabis stocks on Interactive Brokers. Now, I've jumped into the Schwazze investor presentation, and I really like this slide here on the screen where they're showing acquisition improvement, and I like the detail that they've gone into for this. So I wish other MSOs broke this out, but what you can sort of see is the recent acquisitions of they're calling them Smoking Gun, Drift, and Emerald Fields. You can see how they were performing pre-acquisition and then post-acquisition. And in the graph below, you can see how gross margin as a percentage of total COGS has improved over the past sort of 18 months. And you've also got how manufacturing production has been increasing as well from 2020 to late 2021. So they're trying to highlight that they're good capital allocators and that their acquisitions have been incrementally improving their business. And something strange to see in the cannabis space at the moment is that these guys are actually net income positive, which is really great to see. They do have a fair bit of debt though, about $8 million each year they have to pay out. And the CEO, if we're talking about management, has just changed in Q2 2023. I don't think it's that big of a deal. The previous CEO just moved into the chairman role, and the new CEO was promoted internally. I prefer that far more than an external hire because it normally doesn't disrupt the culture too much. They also have a small wholesale part of their business, which is good for some diversification of their revenues, but essentially, I can't figure out what they do that differently. They have this regional focus, I guess, on New Mexico and Colorado. That is different to the others, but it's just different because they're in different states. They seem to be a good operator, and I think that's important, and that can be a competitive advantage. I just don't see something significantly better than everybody else. Why couldn't competition just come in and start really competing in those spaces? I don't really know. I liked how they spoke about capital allocation in that Q1 2023 earnings report and the acquisitions that only make sense to them if they're buying at multiples less than their current stock, which is a really good thing to hear them actually say that. And they don't like stock dilution, and that is uncomfortable for them, but it is not as bad as the debt markets right now, and they've got a lot of debt. So stock dilution is probably the way they're going to have to grow. The business focusing on Colorado and New Mexico, I guess is a good thing. It's just not that special. I don't see big upside here in this one. These are also low barrier states. They will get all the same catalysts though that all the MSOs are going to get. So safe banking changes, 280E taxation changes, federal legalization. They're going to greatly benefit, but everyone's going to greatly benefit, the rising tide's going to lift all the boats kind of thing. But they're growing regardless of the regulatory catalysts, and I think that's pretty important. It takes a lot of risk off the table that they're already growing and already a strong business, net income positive, for example, without those catalysts. A lot of the other MSOs are waiting for catalysts before they become net income positive, and I think that's a weaker MSO. Now, regarding that debt, it's a few years until maturity, I think late 2025, early 2026, according to the report. So as long as they can meet their repayments, which they currently can, it should be okay. But it's a little bit on the higher risk side. They wouldn't want things to get really bad. And if I was to compare them with another business, say MariMed, which I looked at recently, the difference is I see that, Colorado and New Mexico, they're not limited license states. Whereas MariMed, they focus on these limited license states, creating at least some barrier for other competitors to come in. Whereas the issue with Schwazze, just in 1 month in New Mexico, there was 20% more licenses issued. That's up to well over 600 licenses now in quite a small state. And I think these licenses are worth hardly anything, and competition is fierce in the small state. So Schwazze has its work cut out to fend off these raiders, but if they can dominate these markets in these ultra competitive landscapes, I guess it means they are the best and survival of the fittest style. Therefore, they're going to probably be able to expand into other states with these lean, strong operations and be able to compete. So I can see a positive and a negative to the competition kind of thing. So Schwazze have the best gross margins in the industry at 58% and good operating margins at 14%. Their price to sales from a valuation point of view is actually pretty low at 0.39. EV to EBIT's at 6x, EV to EBITDA is only at 4x. The only reason I can see them being a little bit unique is that they're dominant in New Mexico and Colorado in competitive states, and they're well managed, I guess. That debt to equity number is pretty high. Debt to EBITDA is kind of high as well at 2.5x. Some issues I saw, the salary of the C-suite seemed quite outrageously high, and there's low insider ownership in this one as well, which I didn't like to see. Intangibles as a percentage of their assets, so like goodwill and what they're calling their like brands and licenses and things like that, actually make up a big percentage of their assets at about 60%. And I think that's far too high. I don't think it's worth anywhere near that. I think competition can eat that up really quickly. I get nervous about the balance sheet. So where do we put Schwazze? I'm actually going to put them on the B tier. I'm going to put them on the lower end of the B tier for now, mostly because I think that the skill operations that they have, just the balance sheet makes me a little nervous. All those intangibles make me a little nervous, but they're better than some of the big MSOs, I think, based on the fact that they're net income positive already in tough conditions. A low B tier I think is the best. I could put them on top of the C tier, somewhere around there, but net income, they're going to get a fair bit of credit for that. So we'll put them in the B tier for now. I don't think they're as good as MerryMed, but that's where they're going to sit on my little tier list as of today. Stay tuned. We'll do a few more here and we'll fill out this tier list with some of the other companies that I've got to do. And I hope you're enjoying. I'll see you in the next one.